That's where you go. All right, let me read some comments because I'm sure everybody's got a opinion right now. PALL gave up its Friday run up. Yep. Silver down $4 in 40 minutes. Okay. Buy the dip. Remember, the purpose of the market is to sell, but on top of this, recognize that monetary inflation is the way forward. They are engaging in fiscal repression. What is that going to benefit? Metals. It's going to benefit metals. And if they are expanding liquidity, they're expanding capital in the financial system, that benefits Bitcoin as well, because it is a liquidity, effectively a pressure valve. So, yeah, I'm not worried about silver pulling back at the moment. And I am obviously very, very long, given the fact that we have been talking about this since silver was at 25 last March. All right. So, on top of that, last story, liquidity regime, right? Equities and metals rising together. This is the story that is very, very obvious, right? This is the most important slide of the day because equities are rising, metals are rising, volatility is muted, credit is fine, and the dollar is getting weaker. And that combination only exists in one environment through liquidity expansion. So this is not a valuation market. This is not a fundamentals only market. This is a capital flow market. So it doesn't mean that fundamentals don't matter. It just means that timing matters more than narratives at this point as we head into 2026. When liquidity is expanding or it's expected to expand, markets can stay wrong longer than people can stay patient. And that's when strategies like selling premium, trading around insider buying, or focusing on quality balance sheets really can and will outperform outright stock picking. So the question isn't, is the economy good or is it bad? The question is, where is capital going to go next? And again, that's why we focus on momentum the way that we do. And we look at what sectors are positive, what sectors are negative heading into 2026. And right now, capital in the financial system, we are seeing strength in 6 sectors: basic materials, consumer cyclicals, healthcare, utilities, communication services, and financials. Everything else is largely muted: energy, real estate, industrials, and technology. And because technology is negative, we have to be relatively conservative in this environment heading into the next 3 or 4 days. We have no water. Thank you. Oh, this is going great. All right. Don't go to fish. That's the lesson. My voice is gone. All right, Charlie. What time is it? All right. 1 hour 0. Shouldn't this info be on the runner? Don't be a fish. Okay. I did not go to an aquarium. All right, tech. Here we go. TECK. Tech Resources is a materials company. Look, I'm very, very bullish on uranium heading into 2026. Tech is not that company. From my recollection, Tech Resources is a energy name, but I can't recall. Steel, yeah, steel, zinc, steel and zinc. As you know, very bullish on zinc as well heading into next year. It's the one metal that has not completely gone parabolic like everything else. But TECK, way that this is moving, this is just a straight buy. This is just a momentum name. So what you're looking for is what we've talked about in the past, this concept of bounce lag. It's the construct that a stock sells off and then it starts to make a momentum move. We look back to where it has been in the last 24 months and all-time highs up in that mid 50s level. I'm looking for tech to get back into that 50 to $55 level. It is a straight stock buy. This is a dollar weakness story and momentum, as you can see, if you're looking at all of these other indicators, all these technicals, stock continuing to do well, continuing to move back above its 20, 50, and its 8-day EMA. TECK is the ticker. WRB, what do you do? WR Berkeley, Scott has been talking the stock up nonstop. It is in the property and insurance business. And I have been talking about insurance for some time. Same story, right? You're looking at recent highs, stock sells off, it has been bouncing, moving higher. Not much of a very attractive options chain, but we have seen, again, this move out of oversold conditions. This company, in addition to them, looking at companies like Berkshire Hathaway and my favorite, Kinsale, basically just staying in the property and casualty space. This is a way to play the inflation trade. This is a way to play the repricing of the US economy. KE, another name that continues to pop up. Seen this name a lot recently. That is Kimball Electronics. Cheap stock by every other metric. Again, we came back into this environment where, again, $700 million company. Nice pop that has happened since August. It has been consolidating and it's been trading sideways. Same story. Not much of an options chain, but buying the stock and, of course, going back and looking at the fact that we are near all-time highs, strengthen the stock, looking for a move back to that $32 level. All right, cannabis stocks. What are you doing? Well, you would have thought that Tilray Brands would be at an all-time high, given the fact that I was at a Fish concert last night. But no, cannabis stocks continuing to break down, continuing to break lower. We had all that optimism that happened about a week and a half ago around the Trump administration, and now it's giving everything back. And it's just a reminder, these stocks trade with momentum. So when you get into overbought territory, that is the time to get out of the way. They are very highly technical stocks. We had an all-time high back in October, and we have been bleeding off. This is not something to speculate on. Again, same thing. Don't chase these names higher. The purpose of a market is to sell. KTOS, KTOS, one of my favorite stocks of the last 2.5 years, but momentum breaking down. We rode this on the way up. We have to ride it on the way down. And it's been basically chopping around 100-day moving average, 20-day moving average, 50-day moving average, 8-day moving average. Well, we break under this level. We look for a move back down to the 67 level. Way to trade this, buying an in the money put, selling out of the money put. And then if the stock does rotate or moves back up to say like 78, we just take a small loss. But we're looking for a move back into those low 70s. SKIL, don't know what you do. SKIL, Skillsoft Corporation. I don't even know where we found this one, but okay. Wow. Lower highs, lower lows. That is an ugly chart. So, um, I don't even know if we can short this. So, optionality, sure. SKIL. We're looking for this. I'm going to be honest with you. I'm going to just look for this name to move back to oversold. And then I'm going to look for a little bit of a pop. We've seen, you can see right here, right? Oversold, stock moves back to overbought, sells right back off, oversold on the RSI, and the stock pops. So nice little momentum recovery. I've never heard of this company, and they don't look like they're going to make it. NVIDIA, Tesla, U. Okay, so nice thing about this is we're still in this environment where the stocks are moving higher. These are the big names. These are the top names in the S&P 500. They're breaking out. And if you are a day trader, remember, you're going to have no Friday, or forgive me, you're not going to have any trading on Thursday. You can trade the short duration this Friday's options if NVIDIA, which is still in breakout mode, moves off this 1 day average, right, to oversold, or again, we use volume weighted average price as our anchor for this. And if the stock moves to oversold, moves into the 4 standard deviation, what do? You buy the current call, whatever is at the money, and you look for a short-term reversion. Pretty simple. All right, Tesla on is also on that list as well. And Energy Fuels. Pretty simplistic. All right. I don't even know what SKIL is. All right. They're responsible for most of our trading modules. Huh. All right. Well, that's interesting because I'll have to dig into that balance sheet. SKIL. I've never heard of them, but that's an ugly chart. That's a that's a big move down from October. And remember, this was the high. This was the liquidity high. So this is like deeper concerns that the government's not going to be spending. I don't know. We'll look into it. They never heard of me yet? All right. I appreciate that, Ed. I'm famous in my parents' house, Ed. All right. Simple trading strategy for next year. This is the fifth strategy that we're talking about. Remember, we talked about F score and Graham score, right? F score and Graham score. That was quality and value. Now, what I'm going to introduce you to is extreme quality and extreme balance sheet. We did an insider buying strategy. We did volume weighted average price. This is, I want to just say this. It's probably the closest thing to free money in the market. Now, it's not a thrift conversion type thing, but this is a Thanksgiving conversation with Tim type of strategy. um, two parts of this. The Piotrowski score, which I will continue to advocate for all the time. Remember, Joseph Piotrowski, University of Chicago, goes ultimately to Stanford. And in 2002, he is assessing and analyzing value stocks. And he comes up with a score system, a pretty simple strategy of simply looking at a balance sheet and saying, is this company's management doing everything that they should on behalf of shareholders? Now, I know that we focus on momentum. Sometimes we don't really care about earnings. But what Piotrowski shows us is that, yes, these fundamentals, these metrics, they still matter. And they matter a great deal. So he creates a 9-point system that measures financial strength using basic accounting. And it focuses on 3 parts. One, profitability. So your return on assets, your cash flow, and your earnings quality. Part 2, leverage and liquidity. How much debt do they have? Are they paying it down? Are they diluting their stock? What is their current ratio? It's all very complex math. Maybe you studied accounting, maybe you took some MBA classes, or maybe you don't know anything. And if you don't know anything, this number is for you. But even if you are hyper educated, this simplifies everything for you so you don't have to guess. Operating efficiency, margins, asset turnover, so 0 to 9. That's the score system. And if there is an 8 or a 9, you have a very high quality stock. You have a company that is doing everything that they should be doing. But if They're down at like a zero, at a one. They're not buying back their stock. They're not improving their debt situation, right? Then it's not really an investment. That's a trade. So if you're interested in getting what a company is supposed to do, if you're interested in owning a business, you want to focus on the companies that consistently have strong F scores. These filter out those weak balance sheets. But here's the nice thing about it. If I have a very strong balance sheet, what do I do? How do I trade a number like that? That is where we want to sell spreads. I can buy a high quality company for a lower cost if if I get filled, great. If not, I'm generating revenue simply by selling someone else insurance on a great company. The way that we improve the filtering is by adding what is known as the Altman Z score. The Altman Z score is a very simple metric. It takes five different types of uh, bankruptcy or financial distress risk, and it brings it into one number. The key inputs are working capital over total assets, retained earnings over total assets, EBIT, which is earnings before interest and tax, divided by total assets, the market value of equity divided by total liabilities, and the revenue divided by total assets. What we're finding here is stocks that are low bankruptcy risks. So when we look at this number, anything over three is healthy. Anything between 1.8 and 3 is a gray zone, and under 1.8 is very high distress risk. Now, couple of moving parts, right? This becomes a risk filter, not a timing tool, a risk filter. So what we're looking for are companies that have a 8 or a 9 on an F score, and then a high Z score. So 8 or 9, a high Z score over 3. And then what we're doing is we're watching momentum. So is momentum green? Is our score that we do every morning, is this green? And if so, that means there's ample liquidity in the financial system. And we are not buying the stock. We're simply selling put spreads. We're simply selling credit spreads. We sell somebody else the risk or the right to sell us a stock at a very specific level if the stock breaks down. But if our momentum signal is green, very low probability of a liquidity event, and we are focusing again on high quality companies. So what are we then targeting? A high F score, a high Z score, a very liquid options chain, and positive momentum. 80% probability of profit is what we're looking for, a 20% return, and an annualized gain of over 100% so that we can keep doing this trade over and over and over again. And if momentum breaks down, we have to buy we have to buy back the contract, and maybe we don't make anything, or maybe we even take a small loss on it. But these are the types of names that you would want to own in the first place. So again, you're selling a spread, and we're going to talk about how to do this at 3 o'clock today when I'm back in Maryland. You just want to take what the market is giving you. And these two scores are honestly what Tim had described as quote unquote perfect stocks. And I want to just briefly mention what this actually showcases. When you have a high F score and a high Z score, these are the companies that are actually working in this economy at any given moment. Back in 2020, in March of 2020, we did this scan. When we did it on a quarterly basis at the end of the second quarter, so that would have been June, July of 2020, there was only one company that had a F score of 9 and a Z score over 3. And if you want to know what was actually working in the economy, you would know that there was only one name. It was Rent-A-Center, right? The the place where people rent lamps or rent furniture for their homes. That was the only stock that had an F score of 9 and a Z score over 3 because they were the only company that wasn't issuing new debt. They weren't actually going out and expanding their number of shares. So what was interesting about that is that the stock just went up. So if you were selling spreads or you were selling options or insurance to owners of that stock, you don't need the stock to go up. You just need it to just trade sideways. And when you sell a spread, which is very beneficial, why I like the strategy so much, it's very simplistic. I want to own a company. I want to own it anyway, right? It's doing everything the right way. It's got a perfect F score. It's got a perfect Z score. I want to own the company, but I don't have to buy the stock. I can try to sell a spread. And if I get assigned a company with these metrics, 15, 20% lower than it currently is, great. And if it doesn't hit that level, then I'm just generating income. And I know that a lot of people want to aim for 100% gains, 60% gains in 3 or 4 days. I get it. But I think it's very important that you have a basket of these. I don't want to say more conservative strategies. I don't want to put it that way. I want to frame it in this is what the market is giving you. These are the types of strategies that can generate income for you so that you can take those risks, so that you can shoot for the moon when it is time. All right. All right. New junk company in the neighborhood. If they go public, I'll invest. All right. Once again, it is sad. Okay. Yeah, it is sad, but I don't worry about it. I don't worry about politics anymore. What I worry about is getting my voice back today. All right. Guys, it is 9:18. That means my family and I are going to be throwing everything into suitcases and rushing out the door to make our train by 11. My wife is going to try to milk every minute left of rest, even though we have to leave in like 10 minutes. Did anybody do anything exciting? Are you taking the Excella? We are on Amtrak, but we are not on the Excella. We are on the traditional train, which means it'll be late. That'll be fantastic. But again, if you have not done Amtrak in America, it is the best way to travel. It is so efficient. CAG is a recovery trade. We've had a lot of questions about ConAgra. Look, I would wait on this. People are asking about this. Defensives, consumer defensives are still in negative territory. I would wait until put your 8-day moving average with your red line, 20-day moving average, and you're only buying if it is above that line. Yeah, there will be a recovery at some point, but I'm going to tell you right now, this is good money chasing bad at this point, and overall expectations still weakness, still a lot of weakness. And it's a great company, but lower highs and lower lows has been the trend. Don't just buy it to buy. You see that blue line? That's the 50-day EMA. It has bounced off that line repeatedly and just sunk lower. You're going to need to be above that EMA. You're going to need to be above that blue line. So buy it if it's above the blue line, but your stop will be that blue line as well. All right, 9:21. Don's coming up in a minute. If you have not seen Zero Date Don, you better click that link. It's fantastic. I hope everybody has a great day. I will be back home later today, 3 o'clock. Get in the room with us. And once again, we're going to talk about different trading styles, different trading strategies. I will have my outlook for 2026 for you on Wednesday. I hope you guys have a great day. Catch up with you soon. Don's coming up. Take care.